Welcome to our webinar, Making Your Business More Valuable, brought to you by CFO On Demand of Fitzpatrick, Bongiovanni, and Kelly. Please support our sponsors, McPeak Wealth Management Group of Wells Fargo, Ancero IT, Levin Stoller, Attorneys at Law, Allegra Marketing, Integris Investing, Tim Pashley, Cooper Levinson, Attorneys at Law, Rich Asset Management, Ocean First Bank, Sturdy Savings Bank, Bank of America, Persky Marone, Attorneys at Law, Merrill Lynch, Altor Oakley Group.
Few areas of the law have as many changes and complexities as tax law. The Cooper Levinson Tax and Business Law Practice Group handles a full range of issues, including tax litigation, estate and corporate tax planning, business, transactional, and organizational matters such as mergers and acquisitions, and in this ever-changing world, cybersecurity issues. Over the years, our tax attorneys have earned a solid reputation among CPAs, CFOs, and attorneys for their knowledge, integrity, and sound judgment. The right lawyers do make a difference. Please visit our website, cooperlevinson.com.
Hello, this is Lou Bongiovanni, and welcome to our live webinar series. This month's topic is making your business more valuable. Before we get started, I want to address two administrative items. First, I want to make sure you can hear me okay. There is a button on the top right of your screen. You can press that and wave at me or raise your hand and just let me know you can hear okay. Also, on the top of your monitor, there is the ability to submit questions. And I do encourage you to send questions. That is one of the benefits of a live webinar. I will be the only one who sees the question, and I will make a point of leaving time at the end of the webinar to answer all questions. What we will cover in this webinar: how businesses are valued, why knowing your business value is important, and the 7 ways to making your business more valuable. I believe you can't be effective in increasing the business value of a company until you know what measurements are used. There are a variety of advantages and important tasks that you can use in order to have your business become more valuable. So it's important to know the value of your business. And last, the 7 ways of making your business more valuable. I have about 30 years of information to share with you, so let's get started. What's my business worth? So at some point in time in their career, a business owner will wonder, what can I get for my business if I decide to sell it? Or I'm thinking about selling it, how can I increase the value of the business? After all, for most business owners, the value of their business is a significant part of their net worth. So how can I obtain this information? I can't find it in the Wall Street Journal like a publicly traded company. Where do I start? The answer is a business valuation. A business valuation is a formal way of determining the value of a business. By definition, it's a report that includes a calculation done to determine the price a willing buyer would pay a willing seller to arrive at the company's worth or fair market value. Think of it as a real estate appraisal for your business. And similar to real estate appraisals, valuations usually are stated in a range. You might hear this business is worth $2 to $2.4 million in value. When we review the 7 ways of making your business more valuable, we're really talking about how you get to the top end of such a range. So what's entailed in a business valuation? In order to determine how to increase the value of your company, you must understand the methods used to derive the value. So in a business valuation, there are three methods considered, no matter what size of your company. And there's also another concept known as rule of thumb that is worth mentioning also because it's become so popular. I could do a webinar on all of these methods alone, but for purposes of this presentation, I'll give you just a brief overview of each. First, the asset method. This method is hardly used for active companies. It's used when you have little profits or a company is liquidating. And hopefully that doesn't apply to many of the companies that are listening in today. The calculation looks at each asset of the business and puts a value to it, a resale value to the company's assets. And you subtract from that the company's current liabilities. The result is the company's fair market value. Next, the market method. This method is used in limited situations. It's used when a type of business is traded rather often, and there's a common trading with this business. This is also used when there are market comparables for such a business. You see this method when the business is mostly driven by real estate, such as a hotel or an apartment. You'll also see it when the business is commonly traded, as I mentioned, such as a franchise that trades hands rather often and there's a market value on the street. Most companies do not use this method. This leaves us with the income method. This method is the most common by far when it comes to businesses that have profits and goodwill. I'll explain goodwill in a couple of slides. But the way that this method is calculated is you start with the annual net profit of the business. Another variation of net profit is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. That's taking the net profit, making some adjustments to arrive at EBITDA. Another starting point can be the cash flow of the business. Now, once you have obtained one of these three numbers, a process called normalizing is done. And that is where you take the average, it's usually over a 3 or 5 year period of these numbers, and you make adjustments to the extent that there may be certain unusual items that happen during that period of time. So for example, if there was theft that occurred during that period of time or a flood, you would adjust the books because these would be unusual items. Once you have that annual amount, you multiply it times a factor, which is a number, or a capitalization rate, which is a percentage. Your result is the company's fair market value. Rules of thumb are often used in a business. The best rules of thumb are rooted in trends from using the income method. Rules of thumb are usually used when a company has profits and goodwill. It's a commonly accepted shortcut to determine company fair market value. It's usually industry specific and used as a sanity check or a starting point. However, be careful not to use it as the final value for a company because that could be dangerous. Examples of rules of thumb are fair market value is a percentage of revenue. So you might use a certain percentage to a company's revenue. You see, by doing that, you leave out the expenses and the net profit, but it's a starting point. Another example of a rule of thumb is when you take if you're valuing a motel, you take the number of motel rooms times a set dollar amount to derive at a starting point for the value of that property. I mentioned goodwill a couple of slides ago, and I think it's important to explain the difference between business goodwill and personal goodwill. When I talk about goodwill of a company, I'm talking about business goodwill. And that is where a client or customer has a tendency to be a repeat client or customer, no matter who the business owner is. Let's take, for example, Wawa, which is my kid's favorite place to shop. Wawa has significant business goodwill. If you have a problem at Wawa, you're not going to walk in and ask for the owner, Dick Wood. You would go and you would talk to the proper levels of management. So the ownership really doesn't matter when it comes to the dealings with Wawa. So if you and I were to walk into Wawa and want to buy it, and we gave Mr. Wood a big check, we suddenly became the owners, there would really be no different to the customer. That is strong business goodwill. Now let's compare that to personal goodwill. So personal goodwill is where a client or customer has a repeat business because of the owner. So a client or customer keeps coming to the place because of the owner. And one example I give is Bon Giovanni's Delicatessen. That's my dad, who owned a small grocery store in Atlantic City for 63 years. The press did a front page story on him when he retired, called the place an Atlantic City institution. When Mario retired in 2010, we sold the business for $1. He had goodwill, no doubt. He was loved by his customers, but it was all personal goodwill. We would have had to find a person very similar to Mario in order to have a successful sale. Personal goodwill has very limited buyers. This is one of the hardest concepts to explain to a business owner, especially one where the business bears their name. So the value of business goodwill versus personal goodwill can be expressed this way. It's important to have personal goodwill in a company, no doubt. However, business goodwill is much more valuable when you're looking to either sell the company or lend money or do different things depending on the value of the company. So why knowing the value of your company is so important? We've just gone through how companies are valued with various different methods. But why is it important? Why does a business owner need to know the value of their company? Well, the first item we talked about already, and that's if they're thinking about selling it. It's such a big part of their net worth. Selling the company would be a way to fund their retirement. And these are things that are very important to a business owner who has devoted so many years and money to their company. Another important reason to know the value of your company is if you want to add or buy out an owner. If you want to add an owner in, you want to make sure that they purchase the company at its proper value, or if you're buying out an existing owner, you want to make sure that that person is being paid properly. Another important use of valuations is for divorce, to determine the marital assets. If the business owner is getting divorced, the business is considered his asset or her asset and needs to be considered when dividing marital assets. Succession planning. Depending on what you want to do with the business, you may consider gifting it to the next generation. In doing that, it's important to know the value so you know how to structure the transfer properly to minimize taxes. Agreements. There are operating agreements, shareholders agreements that usually include buy, sell, insurance terms if one person wants to be bought out or if someone passes away. It's important to know the value of the company so you are properly insured to fund if any of these events might occur. And finally, bank financing. Banks care about two things when requesting money. One is the value of the collateral, and two is the ability to be repaid. The value of the collateral speaks to the value of the business. I've seen where clients have tried to borrow money from the banks and have been rejected, not fully understanding why. In many of those instances, it's because the business value did not support the amount of financing that was asked. So now let's talk about the 7 ways to making your business more valuable. Let's get the first obvious one out of the way, and that's increasing the company profitability and cash flow. As you recall, I mentioned the most popular way of valuing a business is through the income method. So the more income you have, the more valuable the business. That's pretty logical. And when we talk about income, we talk about 2 components of it. We talk about the revenue less the expenses. So one way of driving up revenue is increasing the average sales and the frequency. Taking our example from Wawa again, if Wawa was able to increase the average sale only a few pennies, because they do so many transactions in a given day, they would increase sales dramatically. Also, if they were able to convince you to come in more frequently, that too would help impact the sales. Controlling fixed and variable costs. It is important to understand which costs of your company are fixed and which ones are variable. Fixed costs do not tend to fluctuate much depending on the activity and the sales of your company. However, variable costs move up or down with your company. I do a whole separate webinar on this area alone because it's so important to sustaining high profitability is controlling your costs. So that is a major factor in improving profitability and cash flow. And lastly, establish financial systems and discipline. This is where we at CFO On Demand focus to helping the business owner. We help them establish financial systems and support their financial accounting department so that we can perform financial analysis in order to help the business owner make important business decisions in operations, for the employees, in marketing, and of course, financial in nature. It's important to have this infrastructure if you want to grow your company, because without it, the company will only be able to grow to a certain extent. Next, number 2, create operating process to be efficient and effective. Everyone is time conscious. Fast food restaurants are very popular. Franchises really try to help make their products or service delivery of their products or services very quick. So establish and document processes to increase speed is very important. Also, establish and document processes to distinguish your company. I'll call that the secret sauce. Google is a great example of this. Google has done a terrific job by the power of their algorithms where customers, where users want to use their search engine in order to surf the internet. Advertisers know this and are very attractive to advertising with Google. So they really have a great understanding of improving a process, and that is why they have such a high valuation and do so well in the stock market. Another thing that falls within this area is technology. You must leverage technology the best you can, especially in this day and age. If you are doing processes the same as you did 2 or 3 years ago, there's a good chance that you're not leveraging the full power of technology. So it's critical to look at that with a fresh eye and improve and see how it improves your efficiency and effectiveness. Next, number 3, focus on the right key performance indicators for KPI. So key performance indicators can be ratios, they're mostly financial in nature, and they help the owner and the employees to perform their best. So creating things such as dashboards, which is a popular concept in management for your key employees, is very useful, especially when you do that in conjunction with benchmarks. So when you think of the concept of driving in a car and you have a dashboard that helps you with the direction or speed that you're going, it's a similar concept to provide to key employees so that they know if they're performing well and they and the business owner are on the same page. It's a way of quantifying your goals. I also believe that creating a vacation report, as I call it, is very useful. This is a report that I encourage business owners to prepare, and it shouldn't be any more than 1 or 2 pages, in order to include items that they think are important to run their business. If they couldn't go into their actual business and they were away on vacation, a longer vacation than they've ever spent, what would be on this report? It's important to create that and utilize that and get comfortable with that as a business owner. Number 4, make the company self-sufficient. Make the company not dependent on you. So you want less personal goodwill and more business goodwill. We used the demonstration with my father, who understood how to create personal goodwill, but did not have a comfort level or an understanding on how to create business goodwill. I hear often from small business owners that it is difficult to do this because of the connection they have with their business. And I agree, this is one of the more difficult things to do because business owners are so proud of their business and they identify so much with it. However, by making it not so dependent on you will allow you the freedom that is important to growing the value of the company. One other suggestion is to allocate the company power so it's not reliant on one person. So if you start delegating more to an individual in the company, you don't want to delegate so much to one individual where you now become vulnerable if that individual either takes part of the business and competes with you or leaves the company. So it's important to empower multiple people in the company so that you have separation of power, but it's important also to have accountability. Next, item number 5, deliver awesome customer client experience. You want to add value to the customer or client. And the company that comes to most people's mind when we talk about that is Disney. You can do this in an inexpensive way. It doesn't have to be as grandiose as Walt Disney does. It could be something such as a particular greeting or going the extra mile for a client or a thank you at the end. And one thing I recommend in this particular situation is that you script what you want your employees to say or how you want them to behave. The more you can script that, the more you replicate what the end result needs to be. And that's the key to adding value. You want to consistently add value. If a client comes in or a customer comes in and one time they get terrific service and another time they do not, you create confusion in the eyes of the customer or client, and that is not helpful in sustaining a great customer experience and increasing the value of your company. Make it convenient. Well, Amazon has done a terrific job at making shopping convenient. They have figured out the best way to deliver products and services to a client. I mean, the future of drones dropping things at your front door, such as toothpaste or toiletries, is not that far-fetched when talking to the people over at Amazon. So they clearly know how to have a great client experience. And their value is very high in the stock market for that very reason, because the stock market is a great way to determine the value of a company, right? We mentioned that, in a publicly traded company. And the reason Amazon does so well is because it's not connected to a particular industry. It does a great job understanding its customer base and what they want. Number 6, keep key employees on board. Hire the best employees you can find. I see what employers pay their employees as being a CPA. And the bottom line is that most successful companies overpay their employees. Now, they justify it by having systems that allow them to get more out of their employees than their competitors. They give these employees the tools they need to be successful, and they give them the freedom. This, in turn, gives the owner the freedom to discuss and focus on other aspects of growing the company. They usually ask the employees for their opinions, and they give their employees feedback. They use the tools that we mentioned before, such as dashboards and KPI, as a way of quantifiably explaining their expectations. Another aspect of keeping the employees on board is providing incentive-based compensation. You want the employees, especially the key employees, to think like an owner. And you want them to be compensated in a way that rewards them if they give exceptional service. One way of doing that is tying in incentives to their performance, so that they too are motivated to increase sales or limit costs or overall helping the profitability of a company. Number 7, reinvest in your company. Make sure your company looks appealing to your target or client market. You need to look at your company to see what can be improved. I like saying that you should go into your company and imagine that your best client or best customer is coming in today, and you want to take a hard look and see if the company gives the appearance that you want or the image that you want. You want to develop capitalization schedules to determine what you want to invest in the future. Don't wait until something is broke there. These capital expenditure schedules are really important to keeping the business going and looking the way you want at a certain image. You also want to constantly improve your product or service. And I thought Apple is a great example of that. You know, recent history when they came out with the iPod, and then they didn't stop there. They did the iPhone and then the iPad. They understand that competitors are always looking at them as far as how to gain market share. And I think they do a very good job as far as trying to reinvent themselves. I also think from a small business owner, you can look at larger companies or maybe even franchises and seeing what they're doing with their products and services just to make sure that you're not falling behind. I'm also a big proponent in traveling, whether you can incorporate it into your personal travel or you want to take special trips. It's important to see what people in your industry are doing outside your immediate market. And you'll be surprised how willing they are to talk about their company. It's usually something they're extremely proud of, and they're more than happy to share their opportunities, their experiences, and their successes, and maybe even sometimes their failures. So one way of reinvesting in your company is to financially reinvest, but also to do research. We have the power of information through the internet. It's never been easier to learn about the trends of your company, of companies in similar industries or of products and services than it is in this day. So there are the 7 ways to making your business more valuable. I'll recap. Number 1, you want to increase the company profitability and cash flow. This clearly is a direct, measurable way of increasing the value. More profitability, higher valuation. Number 2, create operating processes to be efficient and effective. You want the company to run as best as it can in an efficient and effective way, and technology needs to be a big part of this. Focus on the right key performance indicators. Create quantifiable metrics, indicators, benchmarks, so that your key employees know when they've done something right, and you do as well, so that clear communication between you and your employees can be quantifiably measured. 4, make the company self-sufficient. You do not want to have only personal goodwill in your company where customers or clients come in and just want you. There's only so many hours in a day and so much you can offer. So making the company more self-sufficient and less dependent on you is critical. You do want to be careful on how you allocate the power here, but it's critical that you do. Provide awesome customer and client experience. Here, you want to think of companies who do that very well, like a Disney, and what it would take in your company. And again, you could also look at your competitors and what you like that they're doing and maybe can improve on, or areas that other industries have a good customer or client service ideas, and you can apply them to your industry. Keep key employees on board. In order to make the company self-sufficient and efficient and effective, some of the other things I mentioned, you really have to have great employees. And if you leverage technology to eliminate maybe the more mundane jobs in the company, you're left with lesser employees, less number of employees, but very key and important employees. And number 7, reinvest in your company, not only financially, but with fresh ideas and with fresh energy. That makes it feel new to a potential customer or client and makes them want to come back and come and patronize your company more and more. At CFO On Demand, we help our clients utilize the tools to understand the 7 ways of making your business more valuable. We do this by providing outsourced CFO services. We believe a business owner needs to transform from a business operator to a business strategist by making better business decisions in operations, marketing, and finance with the use of financial analysis. The diagram on the left is the example of a business operator. They try to grow their business and make good business decisions. Here, but they keep on getting pulled back because they struggle with understanding what the financials are telling them as far as ways to improve their business. On the right, we at CFO On Demand assist with the financial analysis so that the business owner can stay focused on growing the business and not be pulled back down in the company. We act as a liaison between the financial reporting department, the accounting department, and the business owner, and support them with financial analysis so they can be better strategists as opposed to just business operators. We believe business strategists, and we know business strategists, when competing with business operators, slay the business operators every time. The business strategists clearly have an advantage over the operators because they understand that if they can focus on more than just the day-to-day operations of their business and pay attention to opportunities and threats that are around them, they're clearly going to be at an advantage over their competitors. Now we have a couple of questions that came in during the presentation. I'm going to just take a second to look at those. While I am doing that, here's a list of the upcoming webinars, and hopefully you'll join us. They will be, from this point forward, the second Tuesday of each month from 9 till 10 o'clock. They'll run no more than an hour, and in certain instances less, like this one. Next one coming up is on February 14th. It's cash flow. Where did it go? We'll talk about why cash flow is the lifeline of all small businesses. And on March 14th, we'll talk about the 2018 new tax law and what impact it has on your company. And you see the other ones there. Now for some questions and answers. One question came in is, how do you get a valuation and how much does one cost? Well, the cost of valuations tend to vary with the size of your company. And I don't believe for purposes of knowing internally you need to get a formal valuation. There's ways that you can get just a calculation, which is the calculation part of the full valuation. Those amounts can run anywhere from $3,000 to $5,000 I've seen in the market. Our office has certified valuation analysts and do this type of work. We tend to do most of them for about $2,500 the initial year, and then each subsequent year is less in cost. How long before I see results using the 7 ways of making my business more valuable? Well, there are a lot of aspects to making your business more valuable. Depending on your company and what opportunities there are, there's going to be what people term as low-hanging fruit, which is some easy wins where you can hopefully see them and implement them rather quickly and gain some momentum and some energy so that people are excited, your employees and the owners are excited about doing more. I've seen the best strategy as doing this gradually, where instead of coming up with this daunting list that everyone has to focus on, I've seen it most successful when implemented, let's say, over a 2-year period of time, where you do a little bit each month. You do keep track of the progress, and you make sure that things are moving along. But most businesses are very busy and thinly staffed. There's not people standing around in order to implement a lot of these strategies all at once. So if you gradually implement them, you measure them, you monitor them along the way, and you keep focus on it. I found that is by far the most successful way of implementing these strategies and seeing terrific results. That's the end of our presentation. Thank you so much for joining, and I wish you well.